It's a mixed picture, is the honest answer.
There is a lot of complexity out there to navigate.
We're not out of the woods completely, I'd say, Paloma.
Welcome to The Big Picture, where we connect big themes to credit outcomes. My name is Paloma and Valentin, and I head the corporate finance group for North America with Moody's Ratings. I'm joined here today by Atsi Sheth, our Chief Credit Officer. The first of our outlooks for 2026 are now live, and today we're starting with a discussion of one of our headline structural themes, political polarization, what we mean by it and why it matters for credit worldwide. But to set the stage, Atsi, what are our outlooks for 2026?
Well, it's a mixed picture is the honest answer. So what we're seeing in terms of the macroeconomy, Paloma, is resilience. Growth has held up. We haven't had a recession yet. We are not expecting that in our base case. But different sectors and different regions are facing different challenges. So there are some sectors that are doing very well, and there are others that are facing headwinds. And to find out more, you'll have to read them.
Okay, so let's pick up on polarization. What do we mean by it?
So when we say polarization, and as we've said in our outlook, what we mean is this widening differences in ideas about what is desirable and appropriate for society and the economy. And look, differences of opinion exist all the time everywhere, and they're generally a good thing. But when these differences become so widely opposed and so entrenched amongst voters and those who represent them, then what you have is great difficulty in negotiating or compromising and agreeing on policy outcomes. So that's the polarization we're talking about.
And why is this such an issue for credit?
Good question. And there's a couple of ways that it is an issue, and both are negative. So first, if you think about policy swings, and if businesses or households expect that policy is going to change widely from, one end to another, or that the policymakers are not going to agree on a particular policy for a very long time, whether it's on trade or immigration or regulation or fiscal policy, what businesses are going to do is actually reduce or delay their investment decisions. Same with households on consumption decisions. And this is then going to lower the growth outlook. So that's one negative aspect. The second is, over the last few years, governments around the world have increased their deficits and debt, partly due to the pandemic, partly due to other issues. And now they all have to come together and decide how they're going to reduce this deficit and debt. When you have very different ideas on how to do it, it makes it very difficult to actually agree and reduce those things. So two ways in which polarization is actually affecting credit risk.
Obviously, U.S. policy is in flux. But is this really a global phenomenon?
I would say it is. Firstly, because, look, the U.S. has such a large weight in the global economy that when U.S. policy is in flux, again, whether it's on climate, trade, other things, defense, national security, it just ripples through the world just because the U.S. is doing it. But the second, the U.S. is not alone in having this sort of polarization affecting policy. So I'll just give you a few examples of countries where Moody's own sort of credit opinions or rating actions have mentioned political risk or policy risk as something that's clouding the credit outlook. And the countries are France, Poland, Georgia, Colombia, Brazil, Thailand, Bangladesh. Now, this is not an exhaustive list, and nor is it representative. What I wanted to highlight was, look, there's a range of countries around the world where polarization matters. These are countries that have different credit issues, and there are different rating levels. France is in the AA category, Bangladesh is in the B category, but political risk is actually impeding progress in different ways for all of these countries.
Okay, but the global economy is holding up relatively well, and it looks like tariffs may end up much lower than feared. We have uncertainty indicators out there that seem to have dropped back from their highs earlier this year. So when you look at spreads and issuance also, some would argue that markets have priced in, and actually businesses are largely adapting to this volatility. So what gives, Atsi?
Very, very good question, and very good set of questions. So let me take them one by one. So on tariffs, absolutely right that tariffs that are now currently in place are much lower than what was first announced by the U.S. administration in April. However, U.S. tariffs are still much higher than they've been for the last couple of decades, so they are higher. Having said that, the U.S. economy and indeed the global economy has held up much better than all of us thought when these tariffs were announced in April. Why? Well, one reason is that there's been a lot of trading activity and production activity and buying and selling, importing and exporting to actually preempt tariffs. So when the tariffs were paused, for instance, when negotiations are still going on, there's a lot of activity going on in anticipation that maybe next year things won't be as good. So that's one reason. And the second, and this is largely in the U.S., but not only in the U.S., there's been huge investment, CapEx, related to artificial intelligence and technology spending. And that has sort of buoyed the economy. But I will say this, that even though 2025 GDP growth has been higher than we expected, it is still lower than it was in 2024. And there are some clouds on the horizon. Consumption, especially among low-income households in the U.S., for instance, is falling. The job market is not looking as strong as it once did. So, we're not out of the woods completely, I'd say, Paloma. Mm-hmm. You did say something that I wanted to actually turn back to you, which is on businesses adapting to these sort of series of different policy swings that have come at them. What are you seeing as the head of the corporate finance group in the Americas?
I think many boardrooms, many management teams, many executives are navigating this uncertainty as they would other types of uncertainty. So they're putting together their scenarios, they're looking at risks, they're looking at opportunities, and many are remaining a little bit cautious, right? Prudent on investment, in particular, on financial strategies. And certainly those that can afford to wait may do so for a little bit longer and maybe keeping their options open, just waiting for developments. There is a lot of complexity out there to navigate. So the uncertainty is combining, right? Now, access to financing and liquidity continues to remain absolutely paramount. We've not seen any material disruption on that front, but we're actually seeing more M&A, more LBOs, and certainly if rates continue to decrease as we expect throughout 2026, we're going to likely see many more of these. When you're looking at winners and losers globally, are there any sectors, any pockets where you would like to make a point on? How do you weigh also tailwinds with headwinds in all of this? Maybe widening fiscal pressures. Tell us a little bit about that.
Yeah. So if you sort of, took a step back and say, where are we seeing momentum increasing, whether it's in demand, revenues, or investment? In the corporate sector, I would definitely say technology-related companies are seeing tailwinds. And, in some senses that artificial intelligence is this transformative technology. So there is an anticipation that today, there's a lot of investment and spending going on, but tomorrow that will yield revenues. So that's the expectation. We're certainly seeing some optimism, not just in the financial market, but in the real economy there. Another sector that I'd highlight is defense. And we've seen a change in Europe's sort of outlook in terms of defense spending, especially the NATO members in Europe. And that is certainly driving both actual and anticipated investment in defense. And sort of the outlook for defense companies is also looking up, not just in Europe, but around the world, of course. You talked about where there are challenges and maybe some headwinds, and certainly when you have the economy slowing, as we discussed earlier, and particularly the consumption part of the economy, you're seeing retail struggling a little bit with the impact of tariffs, which affects their costs, and then the impact of sort of slowing consumption growth on their top line as well. Manufacturing companies where, again, large supply chains, you've got to think a lot about your cost base. You've got to think about where you're selling as well. That's an area that we're watching. And I'd say within that, the automotive sector facing a lot. And you know this better than I, so many different things happening with tariffs, with sort of the EV, pressures on EVs, et cetera. So we're seeing some headwinds there as well.
I would certainly agree with your assessment. It's a very difficult balance to strike with trillions of dollars of multi-year investment at stake.
Paloma, since you cover a range of companies, consumer sector, commodities, manufacturing, what's your base case on the global economy?
So the base case is a mixed picture, right, for global growth. We expect around 2.5% in the next couple of years. Policy volatility, credit spreads, hopefully are going to remain or stabilize a little bit more. So a little bit less volatility, a little bit more stability. Now, services is dominating most of the G20 economies, inherently less exposed to tariffs. And where trade is key to success, there's a front-loading demand for goods and diversification of sourcing, favorable financing conditions, fiscal support. All of those elements have helped sustain growth. The U.S. economy has also shown some resilience, but as you mentioned earlier, it is slowing down and it is showing some fragility in certain aspects. So the labor market, the U.S. consumer, which is becoming more polarized. Now, the rest of the world continues to trade and continues to look for strengthening those trade relationships. We also have to take into consideration fiscal stimulus and a more accommodative monetary policy and perhaps regulatory easing, which could further boost the current credit cycle next year and potentially counteract or offset the effects of tariff pressures and stricter immigration policies in the U.S. economy, for example. So when we're thinking about stress triggers, escalating trade wars, fiscal slippage, geopolitical shocks, again, and perhaps abrupt monetary pivots. So again, geopolitics, trade, and market disruptions could be the three key potential sources of stress. Maybe when you think about the single policy area that would most reduce credit uncertainty going forward, what comes to mind, Atsi?
Yeah, I'm not trying to avoid the question, but my answer is the following. Look, I think we're coming out of a period of actually surprising predictability in the global economy. So if you think about the last 30 years, your and my career span, say, globalization was something we expected to continue to move forward over time, and it did. Inflation started to come off from its highs in the 70s and early 80s and continued to stay fairly low. And so interest rates also sort of fell and stayed fairly low. There were, of course, episodes of shocks and stresses, but it was generally overall fairly predictable. I think we're just entering a world that is not going to be so. But the optimistic side of me says the following, that I don't think we should look to policy to provide the predictability or the momentum for growth. It is some of the things that you talked about, how businesses actually adapt to this new way of doing business, whether it's tariffs, whether it's migration, whether it's national security. That is actually going to be the thing that provides us momentum.
Well, I think that's a very good place for us to wrap up the conversation. Thank you very much, Atsi, for joining the show today.
Pleasure.
It's going to be a very busy next few weeks for both of us as we continue to unveil outlooks for 2026. And thank you to all of you for watching and listening. We will have more analysis about our global credit themes on the next episode of The Big Picture. See you next time.
By downloading or listening to this podcast, you are agreeing to Moody's legal terms and conditions found at moodys.com/disclaimer, including that the information provided is not investment or financial advice, and that Moody's will not be liable for losses arising from your use of the information.